Hello everyone, this is Miguel from Financial Analyst Warrior, and today we're going to learn about options. This is a very fascinating topic, but some people find it complicated, and we'll see how we can simplify this. We'll use a real live example. Okay, so we'll use an actual stock, and we'll analyze the four different option position, the four basic option position. So buying a call, selling a call, buying a put, selling a put, and we'll see the graph. We'll see where we make money, in the money, out of money, and all of that in this video. So let's first explain what is an option. Okay, so an option is a contract that gives someone, the holder of the contract, the right to do something. Okay, the do something could be buying something or a security or selling a security. The reason why I say something rather than a security is you can have various types of underlying. Usually people are used to, like stocks as an underlying. So a call gives you the right to buy, Apple, for example, Apple stock. But it can be anything. It could be a commodity, could be a currency, could be a bond, the interest rate, really anything. You can, but like for our purpose, let's assume it's only stocks, okay? Because that's the most popular way to use options, all right? So let's start right away with what's buying a call, okay? So buying a call. Well, and by the way, I say buying a call, you can also say long call. Okay, it's the same thing. Buying a call, owning a call, longing a call. Actually, longing sounds kind of weird. So let's you're long a call. Longing, yeah, I've never heard that. Okay, so what happens when you buy a call is that you have a right. Okay, which is very important. The vocabulary here is very important because when you short, you have an obligation to do something. Now, when you buy, you have a contract that says you have the right to buy. Let's use an example, okay? Let's use a stock, for example, Facebook stock. Let's see Facebook stock is let's assume it's at $62, okay, for simplicity's sake. Okay, so let's assume it's $62.50. It closed yesterday, but whatever. Let's say it's $62. Okay, the current market price of Facebook is $62. So if you buy a call on Facebook, you have the right to buy Facebook share for or at the exercise price. Okay, so for a specific price. Now, let's say you have the right to buy Facebook at, I don't know, $65. So at $65, this is the exercise price. And obviously you're gonna need an expiry date. It's not forever. It's until next month. Okay, let's assume it's June. Well, we don't have to assume because it is really June. So until July of 2014. Okay. So we have a month to buy Facebook at $65. And here we're not going to get into American versus European for now, but just, actually let's get into it. So, since it's so simple to explain, if it's an American option, you have, in this case, the right to buy Facebook at $65 anytime between now and July. You can exercise anytime. If it's an European call, well, you can only exercise at expiry date. Okay, so let's assume in the US the options expire the third Friday of each month. So let's say it's July 18th. You can only exercise on July 18th. And by the way, American versus European, it has nothing to do with the actual location of where the options are traded. It's just like random names that were given like that. Okay, so but it doesn't really make a difference a big difference for our purpose in terms of valuation and explaining what the option is. Okay, so we'll assume it's an American call and puts, but it doesn't really make a difference at this point. Okay, so you're buying call and you don't have Facebook's stock yet. You just have a contract that says I can buy one Facebook share for $65, and I have until mid-July to do that if I choose to. Okay, if I don't want to, I don't have to. Okay, it's a right, it's not an obligation. Very important distinction. Okay, so now let's see on a graph what this looks like. Okay, let's try to make straight lines. All right, so let's do this. Very nice. And then that's straight. Beautiful. All right, so this is it and this is that. So what's this and that? Well, this is the profit. Okay, this is how much profit I'm making from that trade. And this is the price of Facebook, of the underlying price of Facebook stock. Now, before I can calculate the profit, because obviously now I have the right to do something which could be valuable. Now the current market price at time 0 is $62. So right now I'm not making money with that trade, okay, because I can buy at 65. Why would I currently buy at 65 when I can just go on the stock exchange and buy it at 62? I wouldn't do it right now. I wouldn't exercise. However, since I have until July and a lot of things can happen to that stock price, there's potential for me to make money, and that's the whole spirit behind the behind the option trading, right? There's the potential for you to make money. Now, because I have the right to do something, it's not free. There's nothing free in life, okay, except the sun, I guess, or what else? Smile is free. Actually, there's a few things that are free, but let's not get into that. Let's see right away what's the stock or option price. I had like my browser somewhere, or is it here? All right, so I have the CBOE quotes here for Facebook, and this is the July expiry. This is like the most current prices, so it's a real live example. Okay, so that's great. Let's see here. Okay, now you can see here, let's make sure you can actually see. Okay, there you go. Here, now you have the different expiries. Okay, so here's July. On the left side you have calls, right side you have puts, and let's say we're looking for July and at a strike price of 65. So it would be this one. All right. Oops. All right. So let's assume that's the price. So let's not worry about the bid and ask. Let's just put okay, so $1.12, $1.26. Let's say it's $1.20. So I'm paying $1.20 for the right to buy Facebook at $65. So that means I have to spend right away $1.20. So I'm starting with a loss of $1.20. Okay, so minus one. Oops. All right. So it's minus $1.20. Okay, so we can just maybe extend this into the extend this into the negative side. Now, what's happening is, if nothing happens, let's say if the stock price stays at $62, so let's say 62 is somewhere here. Let's say that's the 62 is here. This is $62, and 65 would be, let's assume, somewhere here. Okay, it doesn't really matter. It's just to show you what's happening. Well, if the price stays at 62 or below, there's no point, there's no real reason for me to exercise at 65. Therefore, I won't exercise, and I'll just lose my $1.20. Okay, nothing else is gonna happen. All right, it's just my option, my call option will just expire worthless. However, so all along from 62 all the way to from 0 all the way to 65, I'm not making any money. However, at $65, something incredible happens. Is I'm starting to make money potentially. Okay, because if the price before July or before the expiry rises above 65, let's say, I don't know, let's say it's 70. Let's say it's $70 here. It's not really up to scale, but it doesn't matter. Well, if it's 70, I can still buy the stock because I have a contract that says I can buy the stock for $65. So I can buy at 65 and sell it at 70. So therefore I make $5. Obviously, I still don't get my $1.20 that I spent earlier. I don't get it back. Okay, so this is lost. This is gone. However, I make $5 here. Therefore, net, I'm making $3.80. So that's not bad, right? So what happens is from 65 on, I make money. So let's see how much money. Oh, no, I can't do that. So let's assume it's straight line. It's a 45-degree angle, okay? So it's pretty straight. It's not bad. And you can see that at $70, okay, I'm supposed to make $3.80. This corresponds to $3.80. Okay, that's how much profit I make. And you can see from the shape of the graph that my profit is really unlimited. Obviously, the stock price won't necessarily go to $1,000, okay, where I can make 1,000 minus 65 minus $1.20. But in theory, it's unlimited profit. That's what sounds so appealing about calls, about buying a call, about this specific strategy, is that you can technically make unlimited amount of profit if the stock goes up. If you really believe that the stock will explode on the upside, well, you can buy calls and potentially make a lot of money. And the other good thing about buying a call is that your downside is capped at whatever amount of money you spent earlier for the option. Okay, so that's the premium you spent, which is pretty realistic. $1.20, that's, we saw here, that's about what your where was it? Let's say here, you would actually spend $1.26, but maybe somewhere around that. Okay, so that's how much money you make. However, if the price stays at 62, you don't make any money and you lose your $1.20. Okay, so that's buying a call. Okay, you don't have to exercise. You exercise only if you're in the money. What in the money means is the stock price time T is higher than the exercise price. Okay, in this case, if it's $70, well, $70 to my knowledge is higher than exercise price of 65. Therefore, you're in the money. So all this zone here, okay, that's the money zone. Okay, you're in the money here. Okay, so that's being in the money. At the money is when the stock price is exactly the same as the exercise price. So 65, this is at the money. So I'll write it here. This is in the money. This is at the money. It's a very specific point, specific price. And out of the money is here, when the stock price is below the exercise price. Okay, so that's buying a call. Now, you may wonder, why would someone sell you the stock? Because you're buying it, let's say the price is 70, you're buying the stock for $65, but the stock is worth $70. Who would sell you the stock at 65 when the actual value of the stock is $70? Well, let's see who's that loser. Let's actually draw a graph of the reverse position, which is selling a call or shorting a call. Okay, so shorting a call. Short call. And let's also write some synonyms. It's the same thing as selling a call or writing a call. Means the same thing. To write, to short, to sell. Okay. Let's use short since it's the first one I thought of. And what does that mean? Well, it means, remember, buying a call meant that you have the right to exercise the stock at $65. Well, shorting a call, when you're short, whether it's a call or a put, you have an obligation to do something. Okay, it sucks. All right, so it doesn't really necessarily suck. There's like reasons to do that. Otherwise, no one would short calls and puts, right? And to be honest, I believe that in the long run, it's better shorting options than buying them. Okay, so let's not get into that for now. Let's just explain what the shorting a call is, which is an obligation to, and here you're gonna sell the stock because the long will have the right to buy. He's buying from who? From the short. Therefore, the short is selling. To sell Facebook at a price of 65. Let's assume it's the same until July. Same expiry date until July. Okay. Now let's draw that graph. Okay. So I don't know what happened there. Okay, this is the graph, and this is let's say here. Okay, and same axis, so this is the price of Facebook. All right, and this is the profit that the short is making. Boom. Now the price is still 62 and the exercise price is 65. This is today's price and this is the exercise price, X. Now the $1.20 that the long paid goes right in this guy's pocket. Okay, goes in the short's pocket. So therefore he makes, right off the bat, he makes $1.20. Okay, so if the price stays at at 62, he, or even anything lower than $65, he just gets to keep that $1.20. So he's relatively happy. Well, it's not a lot, obviously, but you should know that options, like most of the options are sold in batches of 100. Okay, so he would make $120, which is not bad, right? From selling one contract, it's 100 stocks of shares of Facebook. Therefore, it's $120. So it's not. It's okay. It's okay. He's making $120. He can buy a nice little dinner. Okay, so let's see what happens after the price goes higher than 65. Well, you can guess that if the long makes money, you know, the money comes from somewhere. It comes from this guy's pockets, because if this stock is $70, and let's assume it's a naked short call. Naked short call means that this person doesn't have the Facebook stock. Okay, he doesn't own the shares. He just sold a call. So he has the obligation to sell Facebook. Well, obviously you can't really sell something that you don't have. Well, you could, but you have to buy Facebook and then turn around and sell it at 65. So if the price is 70, he's going to have to go on the stock exchange, buy at the market price of 70, and turn around and sell it at 65. So he's losing $5. Okay, unless he already has the shares. In this case, it's called a covered call. But let's assume it's a plain vanilla naked short call. Okay, so he doesn't have the stock. He needs to buy it at 70 in order to sell it at 65. Okay, if the other person exercises, if the long exercises. Therefore, he has unlimited amount of I don't know what's wrong with my drawing abilities today. They're just not the par. So let's, well, yeah, it was better the other one, but but you get the picture. Okay, he's facing unlimited amount of losses, because if the price is $1 billion on the stock exchange, he still has to buy it at the $1 billion and sell it at 65. So he makes a huge amount of loss. Okay, this is why shorting naked calls is very dangerous. Okay, because you're exposing yourself to unlimited amount of losses. Okay, and why would this person do that? Well, why would you expose yourself to this section? Okay, well, because of this $1.20. It doesn't sound like a very logical choice, and frankly, it really isn't if you're just shorting calls like that. But if you have the stock, it could make sense if it's a covered call. Okay, so in real life, like, not a lot of people just short calls. It's not a very smart thing to do, I find. That's my opinion. But you would make $1.20 or $120 for a contract, but you're exposing yourself to huge losses, so that's not cool. Now, something I need to clarify in terms of in the money versus out of the money is very often students think that, well, if for the long, in the money means that the stock price that you're making money, basically, that the stock price is higher than 65. They think that for the short, in the money is if the price is below the exercise price, which is not the case. The in the money concept is really the same whether you're looking from the short or the long perspective. In the money means, for a call, means that the stock price is higher than the exercise price. It doesn't matter if you're short or long, it's for the option, because the short versus long is just a matter of perspective. It's the same contract, it's the same option, just this guy happened to have sold it, the other guy bought it. It's the same option. And in the money is still from 65 up, and out of the money is below 65, below the exercise price. Okay, so this covers the call. Okay, now let's see what the put looks like. So obviously we're going to start with going long a put, and we'll see the short put. Okay, so long a put or buying a put. So long put means, and remember, when you long something, when you buy something, you have the right to do something. In this case, you have the right, remember the call, you have the right to buy. Well, here you have the right to sell. Right to sell Facebook, let's say. Let's use the same stock. And now you have to be careful, okay? Longing a put, I've heard that before from some students. Longing a put is not the same thing as shorting a call. Why? Well, because of this word right here. You have the right to do it or not. Okay, you have this option. That's why it's called an option. It's optional. You can buy it. You can sell Facebook, or you can not sell Facebook. Okay. While if you have a short call position, you have the obligation to sell. That's the difference. You're forced to sell. Okay. If the long decides that he's exercising, you have to do it. If you're long, you just have the right to do it. Let's see what kind of prices. See, the stock price was $62. Well, let's assume I'm picking an exercise price of, let's see actually what the exercise price are. Let's see what they look like. So on the right hand side, these are the puts. Let's assume we're picking the same July expiry. Current price is 62. Okay, so let's say whatever, 60. Okay, let's say 60 is the exercise price I'm looking for. And it's about the same price, as you can see, because it's about the same distance, about $2 away from the current price, while the 65 was about like $2-3. Actually, the stock price is $62.50, so it's really in the middle. Okay, so $60, that's my exercise price, and it costs $1.20 again, let's assume. All right, so I'm gonna draw my graph. But first, let's write this down. Right to sell Facebook at $60, and I have this right. It's an American option, so I have this right until July. Okay, so let's see if I can draw a line here and maybe another line here. Okay, so it's the same axis again. So this is going to be the price of the underlying price of Facebook, and this is how much profit I'm making. So profit. Sorry for my handwriting. Now here the premium or the price of that put was $1.20, so I'm losing $1.20. So let's first, before I'm so let's say this is the current price, 62, and this is the exercise price, $60. So now it's a little bit different because I have the right to sell Facebook at 60. So when you draw a graph, it's always a good idea to just pick a random number. Okay, so let's say $50. What happens if the price is $50? Well, I can sell Facebook for 60. So what I could do is I could buy the share at $50 on the market and use my contract to sell it to some loser for $60. Okay, so therefore I make $10. Right? So you can see that you make money only if the price is lower. So therefore you're in the money when the stock price is lower than the exercise price, which is just the opposite as a call. Now, the graph looks like this. Whenever the price is higher than the exercise price, well, I'm not making any money, so I'm staying at $1.20. Okay, so this is, let's say it's $1.20 here, so I'm losing 1.2. This is minus. Okay, it doesn't look like a minus, but it's minus $1.20. Okay, this is the premium I originally paid for my option. However, if the stock price is lower than 60, this is where I start making cheddar. Okay, so let's say, okay, something like this. It's not perfect, but whatever. You get the picture. For example, if it's 50, I make $10. It doesn't look like $10. It's really out of scale, but the point is I'm making money when the price goes down. Now, how much, like when you had a long call, you could make billions, you can make unlimited amount of money because the stock price technically could go to infinity. Now, here you're making money when the stock goes down. So the minimum price for a stock is zero, right? It doesn't go to infinity. It doesn't go to the minus. It doesn't mean anything, right? So because it's limited by zero here, the maximum amount of money I can make is simply the exercise price minus the premium. Okay, so in this case, if the stock goes to zero, I could technically buy the stock for $0 and still sell it for $60. Therefore, making $60 minus my initial outlay of $1.20, so I would make $58.80, which is not bad, right? But it's not unlimited. And again, when I'm longing an option, my losses are limited only to whatever I spent. Okay, so I spent $1.20. This is why some people say options are risky, but it really depends on the strategy. It depends on what you're like. Are you buying? Are you selling? Are you combining options? If you're just buying calls and puts, it's not really. There's not more risk in terms of you can only lose the initial amount of money you put. The same thing as stocks. When you buy Facebook, let's say I buy Facebook shares for 62 today. Well, the maximum amount of money I can lose is $62, right? I can't, if I don't buy on margin, if I just buy cash, well, it's $62. Same thing here. If you buy a put, it's $1.20 that I can lose, not more than that. Same thing for if I'm longing a call. I don't like to say longing. It sounds weird. But if I buy a call, I can only lose the premium I'm investing. Okay. So, well, this is very nice. I can sell Facebook for $60, but who am I going to sell to? If the price is 50, who would buy at such a high price you know, when you can buy on the market at $50? Well, I'll tell you who. It's the short. Being lazy. All right, so short, the put, and again the synonyms were to write the put or to sell the put. All right, it gives you the obligation. All right, run out of space. So obligation to buy Facebook at the exercise price. To buy Facebook at $60. All right, so still the same in the money, but let's erase this for now. And it's not the same graph, obviously. That would be weird, right? All right, so let's erase this. Boom, boom, boom. Okay. Now, the maximum amount I can make when I'm shorting an option is the premium I collected. In this case, I get to keep my premium only if this is the 62 and this is 60, only if the person doesn't exercise. And he's not going to exercise if the price is above $60. Okay, so here I get to keep my 60, my $1.20. Okay, so it was $1.20 here, 1.2. That's how much profit I can make. However, it goes downhill from there, because if the price is below 60, the person will exercise and I'll lose money. So again, it's not unlimited, because the price of Facebook cannot go lower than 0. This is why it's I guess not that bad, but compared to shorting a call. However, it's still pretty painful. If the price, let's say, goes down to $10, that means I have to buy that stock at $60, and then I have a $10 stock. I can either sell it or maybe wait for it to go back up, but I'm instantly losing $50 pretty much. Well, yeah, I get to keep the $1.20, but it's still not cool. So that's shorting a put. Okay, that's how it happens. There's one thing we didn't mention, forgot to mention, which is the break-even price. Break-even price will be the same for the two perspectives, if you're shorting or longing. Okay, so for example, if I'm shorting a put, the break-even price is, and I know as soon as the stock price starts to go down, I start losing money. Well, the break-even is simply how much lower can the price go before I completely lose my $1.20. So it has to go $1.20 down from $60. So therefore, the break-even price will be $58.80. Oops, sorry about that. All right, so it's $58.80. That's my break-even price here, $58.80. And you'll notice it's the same thing for the long. Okay, for the call, if you recall, okay, the call looked like this. Oops, like this, and then boom. Well, the break-even is here, so you actually add, okay, this is the exercise, you will add the premium to your exercise price in order to find the break-even, and it would be the same whether you long the call or you short. Okay, so this pretty much sums it up for the basic position you can take in the four different position you can take in options. So long, short, call, put, and you have to kind of remember the graph, and you have to remember the definition. So for example, when you long a call, you have the right to buy. Okay, so this is very important. So you can just remind yourself of the graph. This is longing a call. All right, the reverse of that is shorting a call, which is this, and then you have going long a put and shorting a put, which is like this and like this. So this should be this is like really quickly drawn, but you should kind of know these graphs by heart for you to kind of remember the different positions. And then obviously later on we're going to have to combine different positions, combining different calls and combining them with stocks as well. But this sums it up for the basic of